The way we describe the sectors that we invest in to make it easier to understand is we use biology to develop sustainable solutions in 4 verticals: food, agriculture, chemicals, and materials markets. When you're a generalist, you just don't have enough hours in the day to have that depth of understanding of a particular vertical. We look for truly differentiated science that is unique, ideally IP protected or IP protectable. Academic scientists are not necessarily great in developing products. They don't have industrial experience. So you need to bring people that have that experience. And I've seen firsthand how arrival of a single person sometimes can positively orient the company towards productizing its science as opposed to being just science.
Well, Joško, thank you so much for coming on the show and for having me in your office in Paris. I appreciate that. Man, you've been investing in biotech and climate before it was cool. You started in 2010. What did the world look like back then when when you pronounce the word industrial biotech and climate tech, because what you're doing ultimately is to help the climate as well?
I guess the world has changed, and at the same time, certain things have not changed as rapidly as we might have wanted. It's probably important to share how we at Sofinnova got into this entire topic, right? And it starts with a colleague of ours, Denis Luquin, who since retired, and who after 25 or 30 years in investing in healthcare, biotech, I won't say got bored, but realized that there are other things that you can do with biology than just cure humans, right? And that also came with maturity of a lot of biological tools, availability, ability to engineer organisms better, faster, cheaper than was the case before. And so he started, I think it goes back to 2008 or 9, with the first investment that Sofinnova did in this space. And then at that time, the original driver, if you want, came from the US, where Americans looked how to gain energy independence by, at the time, trying to produce biofuels. And that was one of the ways to get into this space by replacing fossil-based sources with naturally produced ones through biofuels. The challenge with that approach is that you are trying to develop a sector with almost the cheapest product first, as opposed to starting from the top, creaming the market, developing your knowledge, economics, and all of that in order to get to the cheapest product over time.
So what you're saying is basically like fuel is such a commodity, it's very cheap. So tackling that first as a biotech startup is really difficult because you're competing against like 30 years, 50 years, I don't know how many.
200 years probably.
200 years
of accumulated experience and of assets that have been paid off, right? And so that, in a way, I won't say set the sector on a wrong direction, but it required some course correction over time. And we were, in a way, lucky or smart, pick your approach, not to invest in fuels, but we did invest in the second wave, which was kind of commodity chemicals, and then learned a few things there, course corrected over time, found different models, different ways of doing that, and have started implementing that in 2017 onwards.
And before we get into the playbook, just a quick question, but where do we stand in terms of biofuel? Is that a thing today? Like, do we actually have great biofuel?
Well, if you run a car today, you have at least 5% of ethanol, which is a biofuel, in your fuel tank. In some jurisdictions, you have 10%, depending on the fuel that you pump. And countries like Brazil have been using ethanol, which is a biofuel, since the 70s and the first big oil crisis. So yes, it's there. It's not omnipresent. There's a little bit less of biodiesel in use, but it's not something that have grown dramatically.
Yeah, so a bit less of a revolution than expected, maybe. But look, so we'll try to create that sort of playbook to invest in biotech at the different stages of the company. But before we start there, I think one of the things that I need to understand from you is what do we mean really by industrial biotech? What falls into that umbrella, or at least from your perspective?
I'll give you a couple of answers that probably create a composite picture of the final answer. So the way we describe the sectors that we invest in to make it easier to understand is the following. We use biology to develop sustainable solutions in 4 verticals: food, agriculture, chemicals, and materials markets. Okay, so that's one way of looking at this and describing what we do. There is also a generally accepted division of biotechnology into 4 quadrants. So red biotechnology, meaning human health, red because of blood, okay? And then white, which is industrial, green, which is agriculture and plant-based, and then blue, which is ocean-related technologies. And so if I were to, again, oversimplify, industrial biotech for us is anything but red one.
And part of your thesis is also sustainability, as you said. Like that's one of the key words you said in your sentence. Do you think you can do biotech, industrial biotech, without having a sustainable aspect?
It comes hand in hand in a way, right? Because in many cases, you are replacing fossil-sourced products with biologically developed ones. In other situations, for example, in some food applications and so on, you are developing sustainable solutions that have nothing to do with the fossil sources, but again are more sustainable because they use fewer resources, they're better for the environment, and so on. So for us, this goes hand in hand.
So you've been doing that since 2010. Just a bit curious about where in the hype trend are we right now? Are we at the top? Probably not at the bottom, because I would assume that the bottom was the early years. But where do we sit right now? Like, do you see a lot of interest from generalist VCs as well, startups, corporates in industrial biotech?
So I don't know if you're familiar with the Gartner curve. That goes up, but then swings back down, and then eventually starts going back up. We've tried to predict in the past where we were on the Gartner curve, and we always, got it wrong. Okay, so I won't try to do that. But I think we went through a period, 2020, 2022, okay, when the topic was, I would say, too much in fashion. Okay, and therefore it attracted a lot of generalist VCs that wanted to be part of a new trend. Okay, in particular, in this period, it happened in food tech. Okay, and so some of them or some of their investments were done maybe at unreasonable valuations or not enough differentiation and so on. We'll talk about that later. How do we define good versus better company? Okay. And some did not work out. Okay, so that created a little bit of disappointment amongst that crowd that perhaps went into something because it was part of the wave without necessarily having deep expertise in the sector. So right now we are in a sobering moment, if I call it that way, where some of the startups will make it, some of the startups will not make it, and that's part of a startup cycle. Okay, but those that do make it will get out stronger, will have better product market fit, and a little bit less competition because fewer startups will survive that whole process.
Do you think generalist VCs can play in biotech? And the reason why I'm asking this is, man, it's freaking complex. It's science, right? It's not software.
True. I think the answer is yes, absolutely, but through a syndicate. And to my point earlier, I think some people got overly excited about certain opportunities without, because one of the privileges we have, okay, is that we're specialized, okay, and so I won't claim we see everything that happens, okay, but we see a large part of what's out there in terms of new technologies, both in Europe and North America, because we invest in those 2 geographies, okay, and so that gives you a perspective of what's out there, what different companies are doing, and all of that, and you can compare and contrast. So that's first thing. Okay, when you're a generalist, you just don't have enough hours in the day to have that depth of understanding of a particular vertical. Okay, and so you get excited, rightfully, about great entrepreneur, good team, good story. Okay, and then you plunge in. Right. What we try to do, whenever possible, is perhaps team up with generalist investors that are interested in the space, but need support of somebody who maybe has a little bit deeper understanding of the technology and can help alleviate their worries or compensate for the lack of knowledge that they might have, while still being interested in the space.
And would you say that the generalist VCs went to food as a first sector because it's easier to understand?
I didn't really think too deeply about it, but I think the answer is yes, one, and B, it's easy to relate to. When we talk about food, it creates emotions, okay? If I talk to you about, the plastic cover of your microphone, it doesn't create emotions, okay? It's made from petroleum, right? But for you to get emotional about it because you can make it from, natural oils, it's going to take a while, right?
Yes, for sure. Yeah, definitely. I mean, I wish everything was sustainable there, but I don't think startups are at this level yet. All right, let's get into the core of this episode. So we start the story at the very beginning. Companies probably at pre-seed, right? Few people, an idea, maybe some sort of a proof of concept, not even. Curious to see, what do you look for very, very early, and what makes a great team and funding team in industrial biotech?
So one thing that I think we kind of already said, but it's important to be said again, is that this is still a nascent field. Okay, so it's hard to find repeat entrepreneurs that have that entrepreneurial experience. Sometimes we do find that, and if we can, that's a desired factor. Okay, but if we don't, such is life. Okay, so we look for truly differentiated science that is unique, ideally IP protected or IP protectable, because sometimes some of these stories are just too early to have the patents filed, but you still need to understand that you can file them and get some IP protection. Okay, and then we look at the ability of this team to evolve, and that's where we make most mistakes in a way, right? Because it's so early and we don't invest at that early stage, okay? But we try to track these companies, okay, to see signs of positive evolution and signs of maturity over time. Because normally when you go through something, development of a company, the company matures, but individuals within it also mature. And they understand that they cannot use their original positions and they need to evolve as well. So that's really the original content that you look at. And then we'll talk about that, how that equation changes over time as the company matures. But really, it's about fundamentally great science and great people that can take that science, initially just science, so not even a technology, to the next level.
At this stage, do you want to see some commercial acumen? Because so far you're really focusing on like technology and science. How much of a role does commercial acumen plays at the early stage?
I mean, it helps, okay? It's rarely there. At really, you asked about pre-seed, okay?
Yeah.
It's rarely there, okay? And I think that's fine.
One of the things you said on the science is you want the science to be unique and also could be protected. How do you find that? Like, what makes a science process unique? How do you know that it is unique, right? And then the other part of my question, I guess, is more on the protection of it. How do you know that something can be protected in the long run?
Goes back to your question about specialization, right? So we attempt always to have a team that can understand unique elements of science internally. Then we have, today 25, 26 companies in our portfolio. We can question them what they might be thinking about this science. So we get another data point, and we have a network of people that we know that can also help us judge that. At the end of the day, the judgment or the decision of a VC whether something is unique is still subjective to some extent, okay? Because you collect 360 degrees of opinions where somebody will tell you this is never going to work, okay? Somebody will tell you this is the coolest thing since sliced bread, okay? And everything in between, right? And you have to, at the end, have an opinion, okay? So that's how you, I won't say define uniqueness, but that's how you get to a point where you can make that call. Then the second element, oftentimes neglected by young founders, okay, is IP protection, okay? And here we have, two basic elements. One is can you protect your IP? So can you get a patent for your technology? And then the other one, no less important, is do you have what's called freedom to operate? Okay, are there other patents in the world out there that can prevent you from exercising your technology, even if you get your patent originally, right? So it's about understanding where does a particular technology take you, okay? And then also, over time, mapping an IP strategy of that technology. And so we insist, if you want, okay, for the startups to think about that very early in their days, because if you delay the decision too long, okay, you may end up developing something that either you won't get protection for or you won't be able to exercise because of the other IP that's out there.
Curious also to hear your take at that stage on what makes a science something that can make a great company. Because you can have really cool science, you can have really great companies, but your role is to be in the middle of that, right? How do you differentiate between something that's just great science and will remain in the world of science for the long run versus great science that can apply to the real industrial world, can scale, and is VC backable ultimately?
I mean, this is the place where we start getting involved in a way, right? And so we look, and this is largely based on experience that we learned over time. We look at the very early days whether these technologies that are initially just technologies, okay, no products, can be developed into products. And so here, I just want to kind of define two basic ways of how these startups work. You have sometimes what's called platforms, okay, which is a broad technology platform that can do anything or sometimes nothing, okay? And you have product companies that have one or two products and don't have a platform, okay?
If I try to differentiate between those two, would you say that one is basically you go all the way through the end and produce the output, a product that you can sell, versus the other one is more like a tool that you sell to companies?
No, in both cases, you need to, and we can talk about that later, you need to produce a product. It's just that in the first one, you have many choices, okay? And this is sometimes a trap, okay? Because of too many choices that you have, you need to pick the right one, okay? And sometimes you do, sometimes you don't, okay? So these are just kind of two types of companies. And so coming back to initial assessment and where the company needs to be, you need to look at how can the technology of a company scale over time, okay? Does it scale, okay? And how does it hit cost parameters that are going to make it competitive in the market, okay? And we try to assess that together with the startup as early as possible, because the worst thing that can happen is that we invest money, founders invest 3 years of their life to realize, whoops, it's never going to work. Okay? It's never going to work because it's going to always be too expensive, or it's never going to work because that technology does not scale to an industrial scale.
If we advance a little bit in the stages, and you said like people mature over time. I guess what do you want to see in terms of like milestones as people progress through the different stages?
I think one of the let's stay with people first, okay? Because I think this is an important element in building industrial biotech startups, okay? When you think about the progression of the company skill set over time, okay, where we talked about how you need to have, let's say, cool science, unique ability to develop something, then relatively quickly you need to turn that science into product. And academic scientists are not necessarily great in developing products. They don't have industrial experience. Okay, so you need to bring people that have that experience. And I've seen firsthand how arrival of a single person sometimes that has industry experience can positively orient the company towards productizing its science as opposed to being just science. Okay. So that's one element. Okay.
So the first hire is critical there.
It's not first hire, it's 10th hire. Let's put it that way. Okay. And then as you mature, you need to very quickly start talking to the market. Okay. And this is where a lot of companies, I won't say fail, but do that too late. They don't validate their product thoughts or their product ideas rapidly enough with the market to get feedback. Is anyone going to buy this if I make it? Okay. Because initially it is about concept, right? Okay, we have this technology that can produce product X. Okay, if I can make it at this spec and in this price, okay, are you interested to buy that? you need to have that conversation before you made anything at industrial scale or way before that, okay? So that you gather feedback whether you have, now on paper, a product market fit. And is somebody going to be interested in what you're doing? So at that point in time, you need to bring people that have ability to translate relatively early product development into commercial storytelling.
And at that stage, what would you say the TRL is, roughly speaking?
We avoid speaking TRL, okay, but let's say 5-ish, okay. Because then people come with the matrix and say, I am at this TRL, okay, you should talk to me, and we say, well, okay, but what about this? What about this? Okay, so that's why it's complicated. That's one. Then as you progress, okay, and you start talking about how do you scale this technology, you need to bring knowledge about scaling technologies, about industrial experience, right? That when you remember that you started with scientists, that completely changes the picture of the company. But that evolution needs to happen in a relatively short period of time. So it requires, on one hand, going back to maturity, ability of the founding leadership team, if it's still in place, to mature, and understand that, this is no longer a cool science project. It's going to become eventually a business and an industrialized business, regardless of whether you industrialize something by yourself or with a partner, okay? And I need, or the company needs, very different skill set to make it. And then you go through all these hoops, okay? Eventually, you get into the commercial space, okay? And then you need to be fully equipped with people that know the market, have the right contacts, know how to sell something innovative, okay? Which is not the same as selling, a commodity from a big company that does that day after day.
What is a typical trajectory you see in startups? Because as you said, it's such a different skill set from being like scientists to producing at scale. What's a trajectory that you see from like these early founding team scientists to all the way to like industrial players and sellers?
So typical trajectory is that you have a founding team, you have a leadership team that over time, and now this is highly dependent on the nature of technology, company evolution, and all of that, that either transitions to stay in the technical part of the team. So the company over time hires a new business savvy, fundraising savvy, and so on CEO, okay? And the founder typically takes a chief scientific officer or chief technology officer role, okay? Or in some cases, over time, leaves to do another startup, okay? Because that's where their passion is and that's where their skills are.
And what's your perspective on if you invest in a company and then you see the funding team moving away from it? Is that a signal that you treat as, okay, that's a red flag, or rather they're mature enough to do the right thing for the company?
I don't think there is a single answer, right? It depends on the company, it depends on the technology. In some cases, because, there's no company growth process where you develop technology and you forget about innovation, right? You always need to innovate because you need to be attractive tomorrow to be acquired by another party, right? So you cannot abandon R&D, okay? But you can modify where it's going, okay? And so it depends on a particular case.
One thing we didn't mention so far, which is interesting, at this stage, you haven't talked about market size, right? What's a good market in industrial biotech? What's your minimum kind of range that you're playing at?
We often get asked that question, okay, what should be the minimum market, okay? And the answer is, there is no answer, okay? Why? Because what's much more important is deeper understanding of the dynamics of a particular market that the company is going into, okay? And this is an area where a lot of entrepreneurs fail, if I may, okay, to impress us. Because what we're looking for is not numbers, okay? I'm not looking for a company to tell me, this is a 2 billion euro market and therefore we're fine, okay? We're looking for a granular understanding of the dynamics of this market and how will a new technology, A, be competitive, and B, be able to enter this market, I won't say seamlessly, but easier than somebody else, okay? And that's where this discussion becomes real, and that's where great founders shine.
So you're basically saying that what matters to you is, okay, the dynamic in the market. So in the dynamic, I assume you're talking about the growth of the market, potentially like the changes that are happening.
Growth, who has how much market share. So you have markets that are oligopolies, okay? It's very hard to get into those, okay? Geographical distribution, these days geopolitics and so on, supply chains, all these things matter.
And then the other part of your analysis is basically go-to-market speed. How fast can they enter the industry and seamlessly sell?
Yeah, but let me give you kind of a theoretical example that resembles some things that we saw, okay? We sometimes see companies that are targeting, let's say, what's relatively small market initially, okay? But they're coming at it with extremely attractive economics. So let's say, for sake of the discussion, that, you have a 20 euro per kilo product today, okay, in the market, and that market is 200 million, okay? If you can show that you can make the same product for 5 euros, okay, that all of a sudden opens up many other applications that you can get into, okay? Because it's one thing to theoretically show that there are applications. It's another thing to be able to develop those applications in a timely manner, okay, and get into those. Then all of a sudden your market goes from, 200 million to 2 billion. It's a very different discussion, okay? And so because of the economics that your technology offers, you are potentially expanding the market size.
And maybe just to help me understand that, but don't know if you have some range, because it's my questions are a bit broad there, but I think what usually plays out in the market size discussion is the exit opportunity, and usually it's like what is the price of an exit, quote unquote, like as a multiple of revenue, for example. Is there like a range? Like in software we say 8, well, let's say 7 to 10x, right, or more. What's the range in industrial biotech usually?
So this is a very good question, but it opens a much bigger discussion. Okay?
Let's get into it.
Yeah. So going back to the fact that this is still a relatively young field, one of the challenges that we see in terms of acquisition patterns, okay, is that potential acquirers, big companies, okay, are relatively conservative in looking at these startups. So you talked about sales multiple metric. Oftentimes, the acquirers are looking at EBITDA metric, okay, which puts a much more pressure on a startup to get into a profitable mode and start generating cash flow, okay, before potential acquirers are ready to look at them. And that's a very different situation to be in. Why is that so? One reason is culture of big companies, okay, where we still have a challenge of non-invented here, okay, an ability to rapidly recognize, embrace, and then act on new technologies. And what you see, you talked about software and so on, okay. When we look at IT acquisitions, okay, many of them don't work out. But it's accepted by big companies that some will work, and those that work, they will transform certain verticals within that company. So the acquirers, if I can oversimplify, look at it in a portfolio approach, similar to venture capitalists, right? That knows that out of 10 companies, not all of them will be 10xers, okay? But those that do will make a positive impact on the portfolio. And so when the acquirers start thinking, and you have that, completely ingrained in healthcare biotech, okay, where companies are bought at no revenue ever, right? When they are acquired, okay, because their acquirers know the potential that it brings, okay. Sometimes it works, sometimes it doesn't, but when it does, the payoff is big enough to compensate for the ones that did not work out, okay. In our space, that set of acquirers is still very conservative, and therefore does not pull the trigger early enough to look at multiples of sales, but wants these companies to almost be fully fledged businesses before they take a look at them.
Yeah, and going back to your point on like the portfolio approach, I think if we take the biggest example that exists, I think it's probably Google, where like they've probably acquired by now like 500 companies or more. Some of them, like the YouTube of the world, return so much money, and then some of them just completely fade, and we've never heard of them, which is a perfect example. And
back in, and you're too young to remember that, but back in the internet craze days of the late 90s, Cisco, which is a networking company, was acquiring almost one startup a week. They had a department that would, have an integration plan, print business cards and all of that, because they knew they had to stay at the forefront of new technology.
Well, going back to something you said on going out into the market and asking people, do you want to buy my product if I'm able to produce it? From a VC perspective, obviously you can trust your funders in telling you the story, but do you look at, how much of like LOI, like some of those like paper do you want to see when you invest versus like early discussion? Like where, at which stage do you want the conversation to be when you invest usually?
I mean, it depends whether we're investing in seed, Series A, or Series B, which are all free kind of entry points for us. Paper, as you called it, is good indication of interest because coming back to the behavior of big companies, they're often shy to put their name on the line, and so they won't write a paper. Okay, but we typically want to dig in what's behind that paper. Okay, and we want to see what is the relationship between the startup and the big company, and so we talk to people at big companies to understand, relationship, how long have they been working with the startup? What have they done? What have they tested? What do they think? Where do they expect startup to be so that they can actually, exercise their letter of intent because it's worth the paper that's written on. Okay.
Yeah.
Until there is a binding agreement to, take or pay or, supply agreement, something like that. Okay. It's just a paper. Okay. And so it's behind that letter that we want to dig in and truly understand how does that relationship work? How did it develop? And is it going to be, positive for the company? With full understanding that big companies change their mind, they change leadership, they change direction. Okay, so you have to discount that to some extent to get a true picture that you can expect in 3 years from now.
If we continue on that story, so they start with science, they develop something in the lab, maybe a pilot. What is the risk? Because obviously you see like this from the seed to the Series B is where you enter, right? So it's a very different story. But what are the risks from producing a few grams to producing a few 100 kilograms to producing tons? Like, how does that story go usually?
So it would be naive to say that there is no risk as the company progresses. Okay, the risk changes. But one of the things that's, let's say, atypical for startups in our space is that that risk gradually goes down, but there isn't really a major inflection point. Okay. I mean, maybe the inflection point is when you are really commercial, okay, and you need to invest into your commercialization, sales and marketing, and all of that, okay, then you can kind of say that, okay, now you can rapidly grow the business because you built all the good fundamental elements, okay. But other than that, you're always going through the next point of risk that you need to solve, okay. Be it we talked about kind of product market fit, acceptance, and all of that, okay. But there are industrial elements that need to be addressed as well, okay. So you go from a lab when you're making things in 200 milliliter flask to a small pilot, maybe a bigger pilot, then a demonstration to eventually go to commercial size production. The technical challenges, okay, and engineering challenges are different at each of these stages, but they do exist, okay. And so one of the things that we look at the very beginning when we talk to startups is, do they have an appreciation of how hard this is, okay? Because many times you hear the story, oh, this is easy, okay? And, those are red flags right away, okay? That somebody thinks that something is going to be easy, okay? So you need to dance around that a little bit to really tease out how well-versed they are in understanding that this is a challenge, okay? They don't need to know how to solve it, but they need to accept it and call on the right people to help them out.
How do you differentiate between we have so much ambition and we want to save the world and it's going to be so easy versus we're super realistic and it's going to be tough? Like what's the difference between high ambition and being self-conscious about the thing?
You need to have ambition. Okay, so one of the relatively frequent reasons why we say no to a company is lack of ambition. It shows through, their projection of where they will be with revenue 5 years from now. Okay, if they're not ambitious enough to have high growth, that probably means it's not interesting from a venture capital perspective, and that's probably not a team that we want to back. You don't want. So one of the key strengths of a startup and startup team is ability to sell the dream, right? And so if they're not the ones really pushing the envelope, then it's very hard to back them. So I think your contrasting profiles are a little bit too harsh, okay? But you need to have a team that's able to sell their story in a convincing way, while internally being conscious of the challenges that they will encounter over time and be open to talk about them.
Yeah, I love that. And it's also about that trust relationship with the VC, right?
Well, we can talk about that if you want, okay? Because that's one of the areas where a lot of founders need to be educated on, okay? Why? Because, okay, let's say we get into discussion, we're talking to them, we want to understand certain things about their technology, okay? 95% of the time, they're super protective. They don't want to tell us how something works and so on, okay? And then, we kind of confront them with the question of, what is the business that we're in? We're not in business of copying your technology, okay? I'm not going to start a startup that, copies the technology that you told me about yesterday, okay? I'm in the business of helping you get better in what you're doing with some help of the money that we can put in, okay? Based on experiences that we have accumulated. And this is the key part, okay? The advantage that a VC investor has is that we live 25 companies in parallel. And the learnings from one may be applicable to all 25 from one day to another, and we can do that in a blink of an eye. A startup founder has one company, one effort, and a tough life already. They cannot absorb all this knowledge that's happening elsewhere. And that's the biggest value that a VC brings to a company.
Talking about value that VCs bring to the table, I think that's it's often it almost became a meme.
Everybody is smart money, right?
Right. Everybody is smart money. Everybody is value add investor. What do you see the value that you bring to the table?
In our case, one of the values is the fact that we have lived certain things. Okay, so we have scars. We have scars, and not only do we have scars in the sense that we said, okay, we made this mistakes, therefore don't do this in the future. No, when we made mistakes, and we did many times, okay, we go and look back. What did we learn from that? How do we adjust our approach for starts, okay, to different companies? And secondly, how do we, using this learning, help our companies down the road not to make those mistakes again? And that, I won't say you cannot buy, but, certain things just happen over time, okay? And you develop that perspective over time, and you get to appreciate or understand certain things over time. And that's the longevity angle in this space, okay? The downside of that is that we had to take a lot of early hits, okay, that other people did not, okay, so they can benefit from our learning. So,
Are there a few areas where you've invested into companies, completely failed, hit the wall, the companies went bankrupt, you lost your money, and as such, you don't want to invest into these industries again? Or do you rather have like an approach where you're like, okay, I'm going to learn from every single investment and try not to replicate the same mistake, but still find investing in the same industry?
Yeah, I don't think we have a blacklist in any way, okay? We have what I would call areas of caution, okay? But they're not necessarily related to a specific market or a specific technology. They're more related to certain elements of company evolution that we need to be much more careful about next time around than we were in the past when we made those mistakes.
I'm sorry, but I must ask, tell me the learnings that you had.
So, one of the key areas where we learned a lot in the past is industrialization. How do you go from, lab pilot, okay, all the way to industrial scale, okay? And so over time, and that has also been influenced by the choice of companies that we invest in, okay? We look at companies that have higher value products and therefore have a little bit more margin to play with, because we don't necessarily know, despite all of our skill and experience, where exactly they will land on their cost curve. okay, over time. Secondly, companies that can, as much as possible, produce using contract manufacturing and not build their own facilities. So do they have a super unique way of producing something and therefore need to spend money to produce that? Okay, and sometimes we go down that route, but not very often. Okay, or can they use other people's equipment that has been paid off that may initially cost them a little bit more or significantly more to produce, but they can still make money, okay, without investing in building facilities. Why? Because coming back to the skill set evolution, building a facility is yet another skill set that you need to bring into the company that is very, very different from scaling technology. It's about, executing on a project. Okay. And then that, in some ways, I won't say freezes the time, but, takes 2.5 years out of the startup evolution that is often underestimated or not well recognized by the market. Okay. When you come out of that, okay, and you start producing and you're making your numbers, great, okay? But that period while you need to build the facility, you need to get it going and all of that is very hard, yet not always appreciated by the outside world.
I'm curious, in the industrial biotech industry, you probably don't have a green premium anymore. That probably doesn't exist, right? Like people are not willing to buy it just because it's greener. What is a differentiator? Like we were talking about it earlier a little bit, but what differentiates a product and makes it so unique that corporates or like large industrial players want to buy it? Is it usually based on price, or are there also like, more like specs that are interesting for them?
I'll come back to the green premium, okay? But performance, okay? So I'll give you example of the company that failed, okay, in the past, okay? That was making, it was in the early days that we talked about making chemicals through fermentation. These were commodity chemicals. And they were making a product that was equivalent or next to equivalent to petroleum-based product, okay? They did not understand that because of the way it was produced through fermentation, it didn't have a lot of impurities that were present in the petroleum-based product, and that therefore they had advantage in certain applications. They discovered that a little bit late, okay, and then that was an unfortunate result for them, okay. But coming back to other performance elements, okay, one of the key opportunities that exist in producing products through a biological route is that you can have new functionalities. Okay, so I'll give you an example of a company in our most recent fund. It's a French company called Verlet that produces a milk protein that is equivalent, yet a little bit different than the one extracted from milk, that from a performance perspective, performs much better when used in different products where this is used. So in application, the customers say, oh, we can use it, it's easier than the natural product. Okay, so both are natural, okay, but there are reasons why you want to produce it this way, okay, and you have certain performance characteristics. Okay, so that's one. Going back to the green premium question, the short answer is no, there is no green premium. But okay, if you can make something the natural way, people are going to want to buy it, and because of scarcity, you will get a better price.
I love that. So if we go back to that milk company, would you say it's on par in terms of the price, or is it just priced better, so more expensive for the customer, just because it's actually more interesting and easier to use?
Okay, it depends on the case. Okay, so this company is not at industrial level yet. Okay, so we cannot talk about the okay, but the projection is that the cost in use is going to be lower or at least equivalent to regular one. Okay, and there are functionality or performance advantages. Okay, therefore the customer needs to assess what do they gain.
Yeah. And I guess that's why you also talk with customers very early in that journey, because you want to make sure that you understand that. It's not like only your Excel workbook.
I can give you another example. Okay, very different market. Okay, we have a company in the US called Prometheus Materials.
Yes.
That makes green concrete and green cement. Okay. What's their advantage? Okay. Yes, they have lower carbon footprint. Okay, but in use, okay, their material has certain properties that are superior to classical cement. Okay, and therefore, when you look at what's called total cost of ownership, or how much does it cost you to build the project, okay, their product, even though it's a little bit more expensive, which is natural, okay, gets competitive because it provides gains in other areas that are not just bill of materials, okay? Because when you're building a house, okay, if you take an example, okay, the materials are, I'm going to guess, 50% of the cost, and 50% is everything else. And so you can have influence on the other 50% that's very positive, and therefore your total cost of ownership is at par with comparable products, okay? While providing sustainable elements there all along.
So, I mean, if we thread the needle a little bit on that example, but basically, if you're saying I'm building the house, I'm taking the natural material, it's more expensive, but it has better thermal isolation, for example.
For example, thermal, acoustic, okay, or it's going to set more quickly, okay? So let's say you are, you're painting your apartment. Very simple, okay? You have to do one coat and have to wait for it to dry, okay? It's downtime. It costs you time, costs you money, okay? Well, if the paint dries faster, okay, therefore, you're saving money on human cost, right, and everything else, okay? So this is the classical way to look at this.
Makes a lot of sense. Well, look, we're almost at the end of this interview. I feel like I could talk with you for the next 3 hours if we wanted to talk about industrial biotech. But I guess the way I would like to end this episode is, I'm guessing that if you've been doing that game and playing that industrial biotech VC game for such a long time, it's because they are success stories and because you know that it can actually work from a financial perspective and obviously also impact perspective, but financial perspective is usually first. So if we go towards the end of the story, as we mentioned a few different steps, what are the success stories that you've seen in the market, and what does it look like usually when a company gets to the end of it and does a successful exit, right? And which is usually the end of the game for you, right? That's when you stop following the company.
Yeah, I wouldn't call it the end from a company perspective, right? A company just continues its life in a different form.
But for the VC, I mean.
Yeah, and going back to the discussion we had earlier in terms of appetite for acquisitions by big companies, we're still in very, very early days about that. Okay, it's still relatively rare for big companies to acquire startups. So the most prevalent route so far in terms of creating exit for investors has been public markets. So IPOs, okay, where we list companies, the companies raise money in public markets, and then investors over time can exit their position through public markets. That's not ideal because, there are risks involved with that. And, you are kind of prone to public markets being open or shut, okay, depending on the general atmosphere in the world out there. So that's the risk. So we prefer whenever possible M&A, but today, as we talked about it, okay, this is still a relatively young experience in terms of big companies buying startups.
Interesting. What would be the one company, maybe outside of your portfolio, but what would be the best companies that people should look at if they want to see the biggest success story in industrial biotech, or a couple of companies?
Yeah. So we had, one of the challenges is that some companies were, successful, and then they ran into problems, right? And so the question is, how do you measure success, right? Because from an investor point of view, you could have companies where some investors exited those companies with very positive returns, and then over time, companies did not pan out for different reasons. Okay, and one of the most famous examples is a California-based company called Zymergen that did, I think it was a $3 billion valuation IPO at some point in time, right? And was very promising. Some people made money. So when you look at that from investors' point of view, this is a success. At the end of the day, the company did not succeed, okay, and ended up being bought by another player, okay. But so this is a not an easy question to answer in that sense, okay. And then you have companies that over time, kind of grew and were successful, even though their investors exited them, okay, maybe earlier, okay, but these companies turned out to be success. Okay, so it's not a very, and the problem is that we don't have the data individually. Okay, and so it's hard to judge what the answer is. Right?
Of course. Well, before we wrap it up, is there one topic that we didn't mention at all that you would like to talk about?
I mean, we didn't talk about anything at a macro scale. Okay, and why what we are trying to do is, in my view, important today and tomorrow for Europe. Okay, because we are in Europe. We are recording this in Paris. We are part of European Union, and we're trying to develop a common approach to the future of Europe and its success in global markets. If we look objectively, the science in Europe and the technical base that we have is phenomenal. It's excellent. If we look at accumulated industrial experience that can assist startups in this space, it's probably the best in the world. Okay, again, unprecedented. Okay, creating the appropriate bridge between these two things. We talked about, the appetite or not of big companies to acquire or work with startups is something that we need to collectively work on. Okay, and so when we look at that, it is very important to look at what are the roles of different players in this market that can be played over time to facilitate success of this type of industry in Europe.
And also, I guess you're maybe referring to more of like the geopolitical context, supply chain context right now, which is...
this is something that we cannot ignore, right? Because the advantage, if you want, of the companies that are not powered by petroleum exclusively, okay, is that can be localized in many different places, okay, and that can develop A, supply chain independence, and B, much shorter supply chains. Okay, so you don't need to ship something half a world away on a big tanker. You can produce it, 50 kilometers from here and use it in an hour's drive. Okay, I'm just oversimplifying, right? But so that, in a way, changes completely how you think about application of these technologies. Okay, and it also changes the need for big industrial footprint as opposed to smaller industrial footprint that provides more flexibility and is per project basis on a lower cost potentially.
If people listen to this episode and they want to find you either because they're LPs, co-investors, startups, what's the best way to reach out?
LinkedIn is the easiest thing to do. We're also on our website. So anyway, they reach out. I do answer my messages. Unless they get filtered by spam, which is sometimes a problem, right? Because, some people complain that I did not respond, then I never got their message. But normally, LinkedIn is an easy way to get to me.
And I think maybe your email is public, right, on LinkedIn? Is it not?
It's not public on LinkedIn, but it's public on our website. So, I mean, it's
available.
It's very easy. We won't broadcast it here, but...
Of course. And then one last question for you. Maybe the most important question of them all. Who's the next person that should be in your seat for an interview? Someone, VC in the climate space.
It has to be a VC in the climate space.
A VC that plays.
So Sean O'Sullivan.
Great. Thank you so much. Which fund?
SOSV.
Okay, great. Well, it's been a pleasure. Listeners, if you like this episode and if you like the show, don't forget to like, comment, and subscribe if you're on YouTube, or to give us a follow and a 5-star review on Apple Podcasts and Spotify. It's been a pleasure. Thank you so much.
Thank you very much.